it's going to dwarf the existing system. There's 500 million crypto brokerage accounts. Younger people have zero chance of getting up the ladder. The median 401k in the United States of a baby boomer is $150,000. They're so fucked.
Meet Raoul Pal, crypto and macroeconomic visionary who has been in the crypto space since 2013 and has experienced all the crypto madness.
And then before you know it, you're trading smoking chicken fish or whatever the you're doing.
Over the past decade, he has become one of the most influential voices in the space and is teaching people how to avoid making mistakes and secure a better future for themselves with his company, Real Vision.
Even though when I wrote the first bloody piece, I said it's going to $1 million, I ended up selling out at one point. From 2020 onwards, I've had nothing but 100% of my liquid net worth in crypto.
If this cycle, for instance, goes higher and longer than we all expect, it might tumble over the entire financial system that we used to have.
This is very similar to the 2016-17 cycle. I worry more about the leverage it creates in the system.
Why are the coming years so important in your view?
So the first one...
Raoul, Bitcoin is currently facing 100k or between shooting and going live. It might have broken 100k and gold is reaching new all-time highs. But people are saying it's super expensive. So my first question would be, how do you change people's mindsets when it comes to these two? And what would you say to those people saying that Bitcoin is super expensive?
The issue is people have this anchoring bias on price. So they think 100 is more expensive than 1. But in this weird world of crypto, everything's fractionizable. So you just should be thinking about what are the percentage potential returns going forwards. So let's say Bitcoin usually does about a 3x from the previous high, maybe more, depending where you are in the cycle. So you should be thinking about that return as opposed to the price, because anybody can put 10% of their investments in or 10% of their wages in, whatever. It's a fractionizable asset. So don't look at the number. Look at what you can buy of it and the percentage potential returns. So many people anchor on things that are super cheap because they think, well, one day it could be the value of Bitcoin and therefore I'm going to make 1 million X returns. The world doesn't work that way. It works, Bitcoin is really the anchoring for the whole space. And over time, right, this space is a $3 trillion asset class today. If I extrapolate the trend rate of growth of adoption or price or market cap, you get to somewhere like 100 trillion by 2034, 10 years. So we're only 3% of that journey.
Mm-hmm.
So is it expensive or not expensive? It's probably very cheap. And at every point, and I've been around this cycle, I've been in crypto since 2013, everybody thinks, oh my God, I'm paying the high. And when you look back, when I paid the highs at 200 back in, well, it actually went up to 1,000 and went back down again. Back in 2013, I'm like, I paid the highs. And then I look back now and it's 100,000. That's the thing about exponentiality. People don't understand. They see the cyclicality, but they don't understand the secular exponential trend.
I think, I've been going all into crypto the 1st of January 2018, which was a rough ride. Yeah. Well, I mean, once it goes through those highs is the actual moment when the confidence kicks in. But currently we're in such a weird state where Bitcoin has proven itself in existence, becoming an adult class. Maybe governments are adopting Bitcoin as well. But on the other hand, media is so negative about Bitcoin and still saying it's either a Ponzi or a bubble. Or I can understand that people are getting influenced or being influenced by media. Like, what would you rather see when you see Bitcoin being discussed in the media? Or is it something you're actually seeing at this point? Because I feel like a lot of people will be prevented by going into crypto through those narratives.
So we need to look at what media now. So, we see CNBC in the US is actually quite pro-crypto. So they crossed the Rubicon. So that's the kind of boomer investor generation, and they kind of get a lot of exposure to it. The real pushback is from two sources, the Financial Times and The Economist. And because they are the gatekeepers to the centralized world of finance, they are the power brokers of knowledge. It doesn't exist unless it's in the FT or The Economist has an opinion on it. But here is a world that is inverted to what they know. This is a world that came from the bottoms up, from retail, from individual investors, and not from the power brokers and gatekeepers of Wall Street. And so for them, it's a very threat to their understanding and existence. So, what people are getting exposed to is on one side, this traditional, multiple hundreds of years old media, just endlessly snarking and cynical and terrible about it. But they kind of want the attention as well, because they know there's more attention in this space than everything else. But they're seeing the world of podcast, distributed media, new media, all becoming much more focused around this. This is the battle that even Elon is playing on Twitter. It's, that there's a change of guard of gatekeepers. It's gone towards the individual and away from the centralized. And so that is a battle that had to happen anyway. It's the battle we've been having in crypto with all of finance. And we're seeing one by one, incredibly, all of finance caving in and saying, yes, this is a better system. It's an extraordinary thing that I never thought I did think I'd see, but just seeing it play out from 2013 onwards, it's been amazing the power that this thing has done. It's like a massive, supermassive black hole. One by one, everybody comes across into this new world because the returns are better, the opportunities are better, and the system is just more robust. It's just a better way of building finance and the internet.
I think it's just every cycle. It's my third one now as well. I started a cycle later than you started, but every cycle, especially this one, it's absorbing a new group of investors. And I think in Web 2, you've seen that social media is already taking a lot of the older media out, and a lot of people are diverting into YouTube or X to get the news that they want to see. The only thing that's on a concern for me at this stage is that I'd rather want to see Bitcoin and crypto being discussed in education way more than what it is currently. It's still the old-fashioned system that we're discussing where, hey, it's better to put your money into the savings accounts and to keep your money there for safety. I think that is still something that we need to achieve. And another thing is what we need to achieve is divert with Bitcoin and crypto as two topics. I think a lot of media are still combining the two, but they're completely different. What would you say to these topics and the difference between the two?
So the first one is there is an industrial savings complex whose job is to say, listen, what you need is diversification and you need us to help you manage it. It's far too complicated for you. In return, we'll give you 8 or 9% returns. But they're not understanding that their audience has changed. Their audience is not baby boomers who did pretty well in their careers and had some savings, even though the baby boomers are actually very skewed. There's a whole bunch with no savings at all, because the system let them down too, which was their savings never equated to an ability to retire. The median 401k in the United States of a baby boomer is $150,000. They're so fucked. But you see the average is miles bigger. It's over $1 million. Why? Because it's skewed by the super rich. But then when you go to younger people, 8% returns, considering they've come out of university in debt, considering house prices are 10 times incomes or more, have zero chance of getting up the ladder on an 8% return. So there's the boomer industrial savings complex trying to tell them what works for those guys, but not what works for the customer. And the customer, the client, has a very different need. And so what they've done is that trust broke down in 2008 and 2012 in Europe, the trust of banking, the trust of intermediaries, trust of the middleman, trust of the system. And people have taken it into their own hands. And it's not just in crypto. We see the massive rise of retail trading of options in tech stocks.
Mm-hmm.
Right, it's the same phenomena. People have had to become more speculative in order to get ahead. It's a real thing. So I think that is an important thing to note. It's all about what's the incentive and for whom.
Mm-hmm.
And we have misaligned incentives right now. The boomer industrial savings complex wants one thing, which is your fees, and we want another, which is performance. And they're not going to give it to us because volatile assets don't make as much fees as stable assets in massive size. It's a simple equation.
Mm-hmm. Well, I mean, you've got a lot of exchanges in crypto outperforming a lot of Web2 companies. I think the numbers of Coinbase are way better than the Deutsche Bank, for instance, because the size of the team is just way smaller, but the amount of fees that they generate through either spot trading or leverage trading, which of course in Europe is still relatively hard to use at this point out of customer protection, I think. A lot of Southern European people have been using leverage trading on altcoins. Well, I just feel like, why would you want to do that? So in all essence, the technology is just so fast grasping the old system, right?
Yeah, so here is a stat for you. There are 500 million brokerage accounts in the world in traditional finance. That's India, that's China, it's the US, that's Europe. 500 million. There's 500 million crypto brokerage accounts.
Yeah. Says
already.
a lot.
Already, it's going to dwarf the existing system because it's accessible, it's approachable, there's no gatekeepers. It's everybody with a mobile phone anywhere in the world can use it, whether you're in Nigeria, whether you're in the Philippines, whether you're in Amsterdam. So 500 million. So we're neck and neck right now. And as you say, the companies in the space, if they get it right, it's so much more, this higher margin, higher volumes, and secular growth. While finance itself is not really growing. In fact, if you've got friends working in investment banks, they don't get paid as much as they used to. Their job opportunities are less. They employ less people. There's a secular headwind in finance and a secular tailwind in crypto.
It's a good one that you're bringing that one on because your background is also the old-fashioned finance, of course. What made you decide to jump over and get, well, I wouldn't say full-time crypto, but I think gradually you went more into it? Like, what made you jump over?
So one of the things, if I have an ability to do anything, it's kind of to live in the future a bit. And so when I was in the investment banking world working for Goldman Sachs, I had ridden a secular tailwind. The secular tailwind was the rise of derivatives, the rise of finance, the rise of hedge funds. Okay, so secular tailwind makes any idiot look good in their career. So that made me look good in my career. The next phase was I could see that hedge funds were becoming the big thing, and you could get paid more by working for a hedge fund than an investment bank. Because an investment bank, once you get relatively senior, it becomes a really narrow point of the people who get paid the really big bucks. And it's a very dog-eat-dog world. But hedge funds were broader, new, growing fast, attracting tons of assets. So I made that switch. But when I was in the hedge fund industry, I realized that the institutions had come in as investors, and what they were asking for was lower volatility. And lower volatility means lower returns. And that meant me as a portfolio manager would earn less money, but the owners of the business will get rich because it becomes an asset gathering business and not an asset performance business. So that's when I thought, okay, what is the next part of this secular trend? Well, everybody's starting a hedge fund now. So I started Global Macro Investor, moved to Spain, started Global Macro Investor, which was selling my experience back to hedge funds. And because there was a huge growth of hedge funds, this thing grew on me. But that debt bubble was still coming, and I was writing about it and seeing it. And that was the big secular tailwind for hedge funds, for finance industry, everything else was the big debt bubble. Then it blew up. And then Occupy Wall Street, then the Indignados in Spain, the whole Cyprus banking blow up, the Greece default, all of it. I realized, okay, that's the end of that system. And that's when I went around the world trying to start the world's safest bank with a bunch of family offices. And we actually got stopped. it was a simple idea. We want a bank that only holds your assets in US Treasuries directly with the Federal Reserve. So no fractional banking.
Yeah.
And the
How it's
Dallas
supposed to be.
And the Dallas Fed stopped us. Said, great idea, guys. It's a brilliant idea. We'll never, and nobody will ever give you a license. We had the chairman of the FDIC as the chairman of a bank we were buying. And I said, why not? And he said, because you'll take all the deposits from the system.
Yeah. Says a lot.
So I'm like, okay. And that I wrote about it in Global Macro Investor back in 2012. And that's when a friend of mine pointed me in the direction of crypto. So I wrote the first ever Microstrategy piece ever written on how to value Bitcoin back in 2013 and published that and took a bunch of famous macro guys down the rabbit hole. And then when we launched Real Vision in 2014, I had already kind of integrated it as part of my macro framework of where the world was going. But over time, even though when I wrote the first bloody piece, I said it's going to $1 million, but discount myself, it's going to go to 100,000. It was $200. I said, this is the best macro trade of all time. I ended up selling out at one point and then buying back, but at a higher price. And really, it was not until 2020 that I realized that if I divided the NASDAQ by Bitcoin, it was down 99.998%. And all assets, and it was a supermassive black hole, and this was not going to stop because of the network adoption of an incentivized protocol layer or the new infrastructure of the internet, but it has incentives built in, like for you using the internet, you get paid for it. Mm-hmm. It's like, of course, this is going to just keep destroying everything in its path. And so after that, from 2020 onwards, I've had nothing but 100% of my liquid net worth in crypto.
What's your goal with like your portfolio? Like the overall discussion you see at this point is some people, at least, and we'll get to that in a little bit, are looking to take profits at the end of 2025. But I always say define profits, because are you looking to accumulate more of your fiat? Or as Jack Mallers says, looking to accumulate more Bitcoin, and everything that I do needs to outperform Bitcoin, or I just keep Bitcoin as it yields me 63% on a yearly basis. What's your goal with this?
Lifestyle. What's the point of money? Right? Money really is an exchange for goods and services. So there are lifestyle chips or lifestyle ratchets that you might want, whether it's a house or car or whatever it is that your personal goals are. And those are the things that are the markers on the way that give you a sense of achievement. And it's not about prestige or showing off. It's just what you want. And so you want that because we're humans. It's the sort of thing we like. You also want enough cash because crypto can be very volatile. Mm-hmm. So you either have to have an income or you need some fiat because we have to spend in fiat. And it's never good. You don't want to be spending in the down cycle of Bitcoin because you're spending it too cheap, right? And then the rest you keep in. I mean, the entire last cycle, I didn't take anything out at all because I got income. I didn't need to. And I just bought into the downside of the cycle. And so it compounded my returns much faster. So I was back to all-time high in P&L well before the markets were because I'd just been buying into the cycle. I've spent some time with a friend of mine this weekend who bought Bitcoin at $3 and bought an enormous amount. And he's still got the position.
Wow.
And he only thinks in Bitcoin terms now for everything. Mm-hmm. And he only holds cash and Bitcoin, and he's worth billions of dollars from one trade. Probably the greatest trade of all time.
I can get it if you take profits at some point to accumulate a little bit more cash, because it's still relatively hard to spend your Bitcoin, and there's still the general thesis to not spend your Bitcoin because you can increase your living standard over the next decades by accumulating more. So what we generally say is that, okay, during an upwards trending market, we want to make more Bitcoin by accumulating that through altcoins. And during a bear market, we sell to cash to buy back in lower again to make more Bitcoin. or like more gold, whatever you prefer. At least not a fiat currency, because fiat currencies are devaluing over time. Is that also comparable to your strategy in that sense, or?
Yes, but I don't use Bitcoin because, I think because of my experience in asset allocation over time, I can generally choose the outperforming major asset. That doesn't make me a good, meme coin picker or small big picker, but generally I get the big trends relatively right. So I think that I can outperform over time. But if I were to step away and say, I'm not going to look at any screens anymore, I'm going to go and travel the world for 2 years, I would buy Bitcoin. Bitcoin, so I don't think it's wrong to think of Bitcoin as the base currency, but it's like US dollars are the base currency, yet we buy US stocks. Why? Because we want to outperform the dollar. US real estate. If you think of a family office from the Netherlands that buys real estate in the US, first they buy dollars and then they try and outperform the dollars. I know people don't think in these terms, but this is exactly what we do. Which is why if you're buying emerging market stocks and the currency's weak, it becomes a problem because the stock may go up, but in dollar terms, it's gone down, or in euro terms. So we do need to think in this cross-currency way and what our base currency is. So I don't disagree. I would do the same, and maybe at one point in my life I will do that. But that's, I'm in the wealth accumulation phase and not the semi-retirement phase, because
I
think
agree.
This is the biggest opportunity of all time. So
Yeah, I agree on that stance, and I think I'm at this point I'm still relatively young, I would say, so I can happily go full degen risk on with altcoins. I think it's still the best time in the cycle to do so. But forward looking, why crypto? Like, what is the actual upside there? Why not just invest into tech stocks that are likely going to do well too, or any other?
well, on a risk-adjusted return, they're actually better. They massively outperform. As I said, the NASDAQ is down 99.97%. If you take it even from 2017, the NASDAQ's down 50%. So it's an extraordinary outperformance. So it's a bit of a superpower, but you take some volatility to go with it. But really, all this is a technology that has a built-in incentive system in it. So it's behavioral economics meets the infrastructure layer of the internet. So if you think about, and it also changes lives, and it brings people into the financial system and gives people opportunities. There's a very larger reason why this matters, but it also matters just for the internet. In a digital age, we need to be able to transfer, store, and record value. And value could be everything from our ID to a contract to a store of value like Bitcoin. So it's a very broad concept that's very necessary for the internet as we move forwards into a more digital age, particularly with AI coming at us fast. But it's also the financial inclusion side. It's also the fact that people can access dollars via stable coins anywhere in the world. I mean, these things are revolutionary. And the adoption of this technology is twice the speed of the internet. And it has been. I rebased them both from 5 million wallets versus 5 million IP addresses. And look, wallets is not a perfect thing, but nor is IP addresses. We've all got multiple IP addresses and multiple wallets. Okay, so it's broadly similar. But the growth has been twice the speed of this technology. And so it goes up twice as much as the NASDAQ. I mean, it's pretty simple, really.
Hello, we have partnered with OKX, and if you sign up, you're going to get two important things, which is the lowest trading fees. Right now we have the bull market and I want to trade as much as I can. So I'm very happy with the lowest fees that I can get on OKX. And if you sign up, you can earn up to 270 euros in free money if you hold a certain amount of cash on the exchange. The link you can find beneath here. Make sure to sign up and have a wonderful time on OKX. Yeah, I mean, the only concern that I have is that how long can it still go up as fast as it went? Like at some point you've got the exponential curve and your yields will just go down along with it, right? Because markets expand, markets keep on expanding.
Yes, so for Bitcoin, that will become a very real thing earlier. But for the entire space, if it's going to 100 trillion and it's only 3 trillion today. Will Bitcoin dominance be 50% of a 100 trillion market? No. Where will it be? Where will it settle as an asset class? We don't know. But let's say it'll have the equivalence or larger than gold whenever gold is at that stage. So let's say it's 30 trillion. So there's the 70% that's going to make an extraordinary amount of money.
Mm-hmm.
So I think the S-curve applies to the whole space overall, but the returns are still relatively high to come because we're still pretty early in most of this. And we see that over time. So Bitcoin's returns are coming down. ETH was higher, still is higher, but it's coming down. Solana's higher, but will come down next cycle. Sui or whatever's coming up this cycle, it will still have a couple of acceleration cycles. Then it slows down. But what are we going to argue about? That the returns have gone from 150% a year to 60% a year? I mean, this is la-la land in finance, right? Nobody gets given these opportunities. What is a harder thing is why even start a business? Because I don't know almost any business that consistently generates between 50 and 150% a year returns. And you actually don't need to do anything. You just need some capital.
Mm-hmm. And I think there are a few segments where you can start your own business, and one of them is crypto. I mean, if you start I think there are still not many companies doing actual work in crypto. You see a lot of Web2 founders jumping over into Web3 and basically using a token and AI to improve their Web2 business. And I think there are some very interesting verticals where you can still outperform Bitcoin in terms of performance. But if you start any sort of retail outlet, I think you're better off just spending the money into Bitcoin and just wait for the next few years to come. And I think it's a very...
It doesn't give you is income.
Yeah.
So it gives you terminal value, but it doesn't give you income. So that's the one issue.
What do you think about DeFi on Bitcoin then?
Look, it's coming fast because, I've always said, and I think I was the person who invented the term pristine collateral. It's great collateral. So, of course, if you can lend or borrow it out, I mean, we do it in the art market. We do it for any asset that is deemed to be decent quality collateral. So no reason why not. I mean, however, we are just creating leverage, and humans love sex and leverage as the two most powerful forces in the human mind for some ridiculous reason.
And if I rephrase that question, does Bitcoin actually need DeFi?
So let's say you're the guy who bought Bitcoin at $3 and you have billions of dollars of assets lying around and you get zero return on them in terms of yield to pay your lifestyle. I can see why people want to, and you can do it in a pretty safe way. And there's a few platforms that do that. So I get it. For big holders, for financial holders, banks, asset management firms, I can see why they do it. It's not my preferable path because my rule number one is don't lose control of your tokens. Mm-hmm. And any leverage in some larger drawdown means that you end up getting taken away and your coins don't belong to you anymore, and then you're out of the game. And that's, if it's going from 3 trillion to 100 trillion, rule number one is don't get out of the game. Or don't get taken out of the game.
Well, I've got an interesting one to answer to that. Actually, I had an internal conversation about Michael Saylor.
Yeah.
In essence, he is accumulating more Bitcoin and Bitcoin and Bitcoin through just over leveraging his own company. That's like, it depends on how you look at it.
I know.
But at some point, if he keeps on doing this, his cost base is going to be relatively high. Like you've been adding at like 97K and he probably is going to add at 150K and just keeps on adding. What is your vision on that strategy? Like, is there at some point, is it enough or can you just keep on adding to your balance sheet and having that Bitcoin mentality?
From a philosophical level, is it right for one entity to control all the Bitcoin? Okay, that's something,
It's a
if
good
you're
one.
true to what Bitcoin is about, there should be a limit where you say, well, I don't need to do that. But let's assume that he doesn't blow up because of the leverage, because the cost of borrowing is zero for him, and he's got enough assets to cover stuff. Yes, some assets might have to get sold, whatever. I worry more about the leverage it creates in the system, because MicroStrategy is trading at a huge premium.
Mm-hmm.
That premium is somebody else's arbitrage. And so whether they're buying Bitcoin selling MicroStrategies or buying the options from the convertible note and that are very cheap and selling more, somewhere within that system is an enormous amount of leverage happening.
Yep.
And I don't worry so much about MicroStrategies. I worry about the unwind of the other side of the trade. Because people focus on the MicroStrategies because it's flashy, but this is what happened with Grayscale. Grayscale was trading a huge premium. People didn't realize it was creating gigantic leverage, and everything was one trade, and there was one big customer, 3 Arrows Capital.
Yeah.
And when they were forced out of the trade, it took everybody down, including Genesis, who were the arm of Grayscale, right? So they didn't see it coming either. Nobody knew there was one customer, and that's very typical of a leverage blowout. So we're creating fragilities in a system. The other issue that I've got is there's the 2 times levered MicroStrategies ETFs.
Mm-hmm.
Everybody's trading those. That's causing probably a large part of the premium, plus a bunch of Europeans who can't buy Bitcoin in their pension plans, so they're buying. So there's a bunch of premium being driven by this stuff. But what happens when the market turns and the 2 times levered guys sell?
Yeah, boomerang's
Comes
back.
twice as fast in an illiquid market to the downside. Before you know it, MicroStrategies is trading at a discount to NAV. That blows up all of the people who've been in the arbitrage trades. There's all sorts that can happen that people don't think about. And I've been in financial markets 34 years, and I've seen this repeat and repeat and repeat and repeat.
Well, we've seen it with, what was it, back in Germany in 2011, the automobile company.
Yeah,
I don't know the
Volkswagen.
name. Yeah. It happened the exact way around.
Long-term capital management, exactly the same. That was
Yeah.
so big that the Fed had to cut rates because it was such a mess.
Really?
Yep, it happens endlessly.
Well, if you discuss this topic and you said at the beginning that do you want one entity to have all the Bitcoin? We've got a whole new group of investors from the US coming in, which is bundled under the name of BlackRock, Fidelity, or the big ones, which is getting access through the ETF. That is the first interesting one, having all the institutional investors getting access to Bitcoin and Ethereum. Finally, Ethereum gets some inflow too. You could question whether that is good or bad. And then secondly, you've got a hedge fund background. And actually, we were at the Deribit podcast earlier discussing options trading. How is it going to change the markets going forward? As in, a lot of asset managers are going to use options to hedge their positions. Does it change the dynamics of Bitcoin, or would it be making it more boring?
This concentration within the ETFs is interesting because I think the finance system thinks that they have wrestled control of this decentralized beast.
Mm-hmm.
And they're probably thinking, we've done a pretty good job, boys. That was a close one. We almost had a parallel financial system, but we've got control of it. How I see it is it's actually a Trojan horse, because once you go into that world, you end up going further into that world. And then before you know it, you're trading smoking chicken fish or whatever the fuck you're doing in the space. It's like, that's the path everybody takes, right? Because you go out the returns, you go out the risk curve. So I think it's a Trojan horse. Again, I don't really like the concentration, but I also like giving people access in the ways that they want access, and things like pension plans and stuff like that. The use of options, I don't know. Now we've had obviously Deribit's huge, so there's a huge market in options already, but this will dwarf that. It's good because it takes some of the risk out of Deribit being the only option exchange, which is very healthy. But it's going to be a battle between who uses the options, whether it's the option overwriters who dampen the volatility. So that would be institutions who are long the Bitcoin ETF and then sell calls against it. Right? That's very typical to create a yield out of Bitcoin because they want a yield because they've got pensioners to pay, and yield is very important to them. The flip side is, what is the power of retail and their ability to punt options? And so far, it seems the balance of power these days is in the retail hands. So in which case, we can create a lot of short squeezes, gamma squeezes, all sorts of stuff. Now, it probably dampens the volatility on the downside. I've got a working hypothesis that we all think we're going to be given the gift of all gifts again, which is Bitcoin falls 75% and we get to buy it down 75% or alts down 95%. And it's become so obvious that we're just like, well, at the top of the cycle, I sell out, I buy it back, and I become hilariously rich. My fear is that doesn't happen this time. We don't withdraw massive amounts of liquidity from the system, and that 401k buyers of Bitcoin balance up the selling effects. Yes, we might get the blow up of the MicroStrategy's trade, whatever it is. There's going to be messy, but the ability to use options, put options, I think will balance out some of this. So my biggest fear is not the down 75%. We're all used to that. It's the down 40 and we miss it.
I mean, this is so interesting, as in, first of all, you've got a bunch of people that came into crypto in the previous cycle, and they are like, yes, so October 2025, I'm going to sell during that period. That group is relatively large, expecting the peak to be at that exact moment, already talking about it currently. So it's going to be either way earlier or substantially later. It's not going to be the exact same scenario as everybody expects it to be.
Ask most people who were in last cycle, and that was their first cycle, they have tremendous PTSD because they looked back on the 2017 cycle. And 2017, the market peaked in March before tax season. It then corrected. So it peaked at 2000. It then kind of corrected. And then it went up. It went up 10x in 4 months.
You had the China correction in between as well.
And so last time, I also thought, okay, we saw the tax season correction. Then the rally back up. It was a big correction, down 50.
Mm-hmm.
Then it shot up. And it's like, okay, it's going to be 2017 again. And it wasn't, because the central banks were starting to withdraw liquidity, and the business cycle had been brought forward by the massive liquidity was starting to come away. And that was the end of that. So this time, when you go on X and you see people, they are so PTSD'd by that I think that many will sell tax season March and then get trapped out.
Mm-hmm.
And then they'll expect an early peak, and maybe it does peak. From my liquidity work, it still suggests that it peaks at the end of the year, towards the end of the year. But it depends what happens to liquidity. But if that is the case, I just think the risks are here. And then the risk is 2026 is the people who then sold out, maybe they screwed it up and maybe they got out like I did in 2017 way too early. You then try and buy it back, and you end up buying back at much higher prices, which is what happened to me. I ended up buying back in COVID in that crash, and I got in at 6,500, but I'd sold out at 2,000.
Mm-hmm.
And I'd done the job. I sold out into strength and bought into weakness. Difference was, in a secular exponential uptrend, the difference between that peak and that trough was like this.
It's it's super hard to time the market well. And I think that the previous cycles have shown that the complexity of the markets are going up significantly. I mean, there are more variables that we need to take into account when we trade into crypto or in any asset class at this point. And especially if you look from the macro perspective, I think crypto is having a lot of good factors right now. Trump is getting into the White House. At least his promises are very productive for crypto in the short term. China is increasing liquidity by a magnitude we've not seen for years. So would it be, like you often phrase, banana zone? I think Plan B is saying super cycle. They're all like some sort of potential cycles that we could have. But is the macroeconomic framework going to push Bitcoin and crypto further ahead this time than in the previous cycles?
We can't tell because liquidity is actually the dominant factor. So right now, we look at the business cycle using the ISM survey. It's below 50, which means the manufacturing is still contracting. So, okay, we're nowhere near tightening financial conditions. They did tighten because the dollar went up and rates went up, but the Federal Reserve and the governments need to change that because we need liquidity in the system. So even if it went up every single month for 9 months, it's still September next year before you get somewhere near a peak in the business cycle. And crypto tends to kind of that tends to be a rolling top, and crypto tends to have a rolling top around that. So I think it's longer than people imagine. So it's later in the year. Because people are so scarred by last time around again. And if I look at it on a probabilistic basis, when we took off so aggressively in 2023, I'm like, okay, look, there is a chance that we front load the cycle. But then we had a 8-month correction, and that kind of put it back on track. And so therefore, I think we've got two odds now is, does this look like a more normal cycle? What that means, I don't even know anymore. But let's say 250,000 Bitcoin. Or do we get something like 2017 and 2013, which is something a bit wilder? And I think the probability has gone up for me of that. But, I don't make predictions on this stuff because it's pointless and you just get trolled on the internet for making predictions. But probabilistically speaking, from what I know today and what I know about liquidity and the regulations and everything else, the probability is that we're going to get a more violent upside cycle with lots of volatility in the middle. Like, liquidity has been falling for 2 months now, 3 months. It's fallen quite sharply. And that's whether you use Global M2 or whether you use our Global Liquidity Index, total liquidity that we produce at Global Macro Investor. It maps really well on Bitcoin. Now, these correlations don't last forever in a perfect form, but it's been perfect. And it would suggest that the market peaks sometime December, end of the year, early Jan, and sharply corrects, which is exactly what happened last time Trump came in. When Trump got voted in, the dollar screamed higher, rates went higher. He actually came in, rates went lower, the dollar went lower. But that run-up over the Trump getting voted in 2016 caused a 35% correction in January of 2017. In the end, it was all noise. But, we're going to get to that. We're going to get to very frothy. Some people are worried it's happening now as we speak. Maybe. Doesn't look like it according to my work. It would suggest later. But, who the hell knows? But we'll get one of those to come. Then we'll have the post-US tax season version as well. Because in the end, people are going to have a lot of gains. And if they've switched anything around, they're going to have to pay the tax man a lot of money. And they have to sell stuff to realize profits. And that's that kind of sell in May and go away idea that generally works. It's tax season.
Well, it worked this time again.
Yep.
The summer was like the most boring I've experienced it in, I think, since I started in crypto.
Yeah.
And I know it's very hard to make predictions where the markets are going to go to. At least if you look at the crypto markets, Bitcoin has seen a very strong uptrend since, the FTX crash in November 2022. But on the other hand, there are a lot of things putting down the crypto markets at this stage, which is we're still in a relatively high interest rate climate that, yes, you're mentioning PMI, and that's contracting for, let's say, 6 to 8 months already, and it's going down even more. But the Fed is very stagnant on the interest rates, are not really looking to cut it a lot in 2025, unless the labor market data is going to keep being terrible. And I think the past few months we've seen a substantial drop in job openings, in ADP, all those data points. Would that probably kickstart another strong move in anything related to crypto? As in, there is
Okay.
some sort of correlation with ETH and the yields, right?
So that is the global liquidity,
Mm-hmm.
right? And that's, or we use Fed net liquidity is another one. Either way, or financial conditions, even better. Financial conditions that we use are basically rates, the dollar plus oil. Those are the kind of three variables that really matter for the global economy. Oil has been falling, so that's dampened the issue somewhat, but the dollar screamed higher, as did rates. Now, that has a lag on the economy. So we're talking about it having a lag on crypto. We probably see a slower economy in Q1 or Q2 than people are expecting, which plays into the idea that you've got is, I think the market is underpricing cuts now by the Fed, and they kind of go through this madness every time this happens. They're like, well, it's one and done, or well, it's just a little bit. They're never going to do it. And then eventually they have to, because they've got to roll $10 trillion of debt, as does every other country in the world. And financial conditions are far too tight for the Chinese. If the Chinese don't get their economy going, we have no export market. We've got no bar of treasuries. You know, Europe is struggling as well. Germany's in a total mess.
Mm-hmm.
So we need to ease financial conditions, and they all know it. And they've had to hold on as long as possible because inflation had been higher in the previous cycle, and it cost everybody the election. Every government across Europe, pretty much around the world, that was in over COVID got voted out. Why? Because prices went up so much on people. So they're very nervous about that. But we've now got a new regime. So I think you're right. I think the probability is the economy's weaker than expected, and that gives them the green light that they've been after forever.
I mean, is there, I think what is my PTSD is that crypto basically boomed during COVID, where the world completely got destroyed and crypto did well. And I kind of get the feeling that we're again seeing the world just being destroyed and crypto starts to do well again. Is it like,
No, I don't think that. This is very similar to the 2016-17 cycle. Rates went up once in 2016 and then stopped. Didn't go up again. In fact, the Fed didn't even put any liquidity in, but the Chinese had to because the dollar had been too strong prior, so they really had to stimulate. And then the Europeans and the UK then had Brexit, and they started simulating. So the US didn't need to be doing it. Same in 14 and 15. I mean, rates didn't move. There was a bit of QE that came out of Europe, obviously from the banking thing, the Draghi, everything it takes. But then after that, crypto, the amount of movement in crypto doesn't need a massively large total amount of liquidity. People just over-focus on the Fed, over-focus on balance sheets. Just as long as global liquidity keeps rising by 8%, crypto will still do 100% a year. It's kind of, so I worry less about it. I think, again, people have an anchoring bias on the last cycle, but having seen three of them, the last one was the outlier, and crypto went up less and finished earlier. So therefore, that kind of doesn't make sense if it's just the liquidity cycle. I think a lower volatility cycle in terms of the economy actually creates more risk-taking than a higher volatile cycle like COVID.
I think you're saying something very interesting there, which is that previous cycle felt completely different than 2017 for me. I think if you look at the terms or the groups of participants in this cycle, it's a whole new dimension compared to the previous one. And 2021 wasn't really a group of new investors coming into crypto. It was a bunch of venture capitalists and funds just jumping into crypto, just trading it, and that's about it. Now we have actual institutional investors, governments getting into the markets, which in some way if you, on top of that, combine it with the amount of debt that we have, 2008, it creates a vibe that we might have the final easy cycle and then perhaps have a copycat of 1929-ish, where all of a sudden the debt bubble bursts.
Can't happen.
Why?
So what happens in a debt deflation is the value of collateral falls
Mm-hmm.
in excess of the loans, and so it gets called on,
Yeah.
and the collateral gets liquidated. What they learnt in 2008 was a very simple trick. Debase the currency and the asset optically goes up. That was the whole Draghi thing. That was everything. So we cannot do that because we know the mechanism, the US, that is. Can it happen in individual countries, whatever? Yes, but not the US because it has the reserve currency and has the fiat currency. So the 1929 scenario cannot happen. It simply can't happen. We've taken that left tail out. However, let's say, okay, Bitcoin goes to 1 million this cycle. It's a stupid cycle. It all gets out of control. Massive bubble. Could we skip a cycle? That's possible. Could we fall 75%, rally, don't go the new high? We've seen NASDAQ skip a cycle. NASDAQ skipped a cycle from 2001, where it fell. So 2003 low. It kind of skipped a cycle first before it really started going. So, I'm open to that idea, but we'd have to see a full-blown bubble cycle. My guess, that's the next cycle. I think that's the whole everything, AI, ridiculous, everybody knows the game, bubble cycle.
I mean, it's something that you phrased as the exponential age and the growth that goes along with it. But something that comes up in my mind is that crypto is very retail driven. And once you get like 1.5% to 2% in your savings account, and all of a sudden DeFi becomes attractive, and it is like 10% or 15% yield you could get. The higher this cycle goes, the more vertical it becomes, and the more liquidity being added into crypto, the more fragile the banking system will be. So there might be, in my case, or in my thought process, a thesis that if this cycle, for instance, goes higher and longer than we all expect, it might tumble over the entire financial system that we used to have because of the fractionality that we have in the banking system.
Just don't think that much capital can leave.
They don't allow it, that's the thing.
Yeah, that's right. And think of the size of money market funds. Think of the size of that boomer industrial savings complex. Think of the size of the financial system. Right? We're just seeing such a fraction that I'm not sure it's going to be deposits. I mean, we've seen similar, which was 1999. It didn't threaten the banking system. That nobody wanted money in their bank. They just wanted to buy tech stocks. Because tech stocks were just vertical in the fastest acceleration of any stock market cycle in all history at the time. And then there was the blow up. So I hear what you're saying. I think it more happens over time. This migration keeps happening. And that 3 trillion to 100 trillion is also the 500 million active wallets now, to 1 billion active wallets, to the 4 billion active wallets, to all the agents and AI agents using wallet. I think it just happens over time. And I think everybody's okay with that. But, if you were right and everybody jumped ship, both ships probably sink.
Yes, and that's something that we shouldn't be wanting at all. But I think, to me, it's just like, because of the amount of opportunities that we have, and you phrase it in the coming 6 years are going to be super important for yourself. I think the amount of opportunities are there, but the volatility will go through the roof. The emotional decision-making and biases are going through the roof as well. There are a lot of risks implied. So it might swing a way that it's just too large for the financial system to handle. But the question that I wanted to ask on this was like, why are the coming years so important in your view?
Because of what I term the economic singularity.
Yeah.
So how economies work, once you understand this, you understand why we're in the mess we are, what's going on, everything, is GDP growth, trend rate, is driven by demographics growth, so population growth, productivity growth, plus debt growth. So if we think about Europe, where you are, we have aging populations. We tried to import labor, but in every country in Europe, they're like, whoa, this is too much because we've got this old population and the society pushes back against too much immigration in one go. So we're kind of stuck at this thing, right? And as you get older, you become less productive. So these rapidly aging populations, just look at GDP and look at the trend rate of GDP and look at the age of the population. Japan, the slowest, Italy, country by country by country. It's that. And the US is better because they've got a younger population. Okay. What I then found is the labor force participation rate, i.e. the number of people in the workforce, as a percentage of the total population, that keeps falling over time because people are retiring. But when you invert debt to GDP, it's the same chart. So debt growth has just been a function of demographics, trying to support an economy of aging people, and that's every country in the world. Same thing. Okay, so we're in that trap right now, and we've got all this debt that we built up that we're just rolling. And we're increasing the debt just to pay the interest. That's the game. It's not from government borrowings in excess. They're not doing huge infrastructure spend. It's just servicing debts that keeps raising the debts. So that's creating this liquidity and debasement of currency. It's the servicing of the debt. Because they don't want it to go bust. You can't let the collateral go bust because the system's too levered. Everything goes to shit. It's a down 90% of everything and it's the end of the world. So they're not going to let that happen. So we're in this cycle until something changes. So you hear Scott Bessent, the new Treasury Secretary of the United States, saying, we've got one chance and that's to try and grow our way out. Okay, fine, because GDP growth is the economic activity that pays the interest. Don't forget, the private sector's 120% of debt to GDP as well. So it's kind of totally screwed up. But the question is can you sustain it with an old population? It seems provably not. Can you shift it a bit? Maybe. But in 10 years' time, something like that, 5 or 6 years' time, we've got a new thing to compete with, which is the rise of AI. And AI is basically human knowledge, but at an infinite scale. We can create endless. We're already seeing how fast, these very early crappy agents on Twitter are, but they're coming in their thousands, like meme coin proliferation. So we're going to create unbelievable amounts of AI, which is human knowledge, and the applications that make it easy for us to use. So then we don't need knowledge workers, doctors, lawyers, radiologists, whatever it may be. And then the robots. Amazon now employs more robots than humans, and that's only going to keep accelerating. So that means we're going to get infinite humans or replacement humans, which means if you think of the formula, if population growth goes infinite, what the fuck happens to GDP? It goes through the roof. But who does it accrue to? The agents, the AI companies? Who? But it's not the individual. Then you've got productivity. So a lot of people argue that Europe is wasting money by all of its green energy stuff. I don't think it is. I think it's a calculated decision to increase productivity in Europe. Is one of the simple ways of doing it without changing the population side is lower the cost of electricity over time. And so if you do that, you get more productivity, you can have growth. And growth will stimulate the economy. This was the playbook in the 1950s. In the 1950s, we had the massive debt from World War II, financial repression, which is debasement of currency, gradually over time, massive infrastructure spend, eventually grow your way out, technological revolution, late 60s, 70s happen, etc., and a population boom. which we don't have. Well, we do have. It's going to be robots. So after that, when AI is everywhere and we have an age of abundance, what is money? What does money buy us? What are jobs for us? What does it mean to have a business? People made all their money in SaaS businesses, but a SaaS business is just a kind of front-end software that sits on the internet. And if you just give it to a powerful AI and say, build me this, within a year from today, we'll be in a system that it can copy anything, build any website. If you say, hey, Michael's built a really cool DEX and it's really different, I just give it to my AI and say, hey, copy Michael's DEX, but do it in Hindi because I think the market's bigger. And it'll say, no, don't do Hindi, do Indonesian because there's an underserved market. Off we go. Right? So you have no moat around any business anymore, unless it's a physical thing or a hardware manufacturer. Hardware manufacturers, look at Tesla, they're using robots. So it's a very complicated world. What are markets when you've got AGI? AGI is coming, whether it's in the next 2 years, 5 years, it's here. So if Moore's law dictates that computational power doubles every 2 years, what we're seeing is intelligence at AI level is doubling every year. So by next year, we're at 120 IQ now. Next year it's 240, then 480. Okay, this is la la land. What are financial markets? This is going to do better than us. There's no point in us trying to trade. So, okay, fuck. This is a big issue, but I kind of think this is all going to end in a massive bubble because we only have one solution here. It's to make as much money as you can in the next 5 or 6 years. Now, I'm not saying 2030 is the absolute date, could be 2032, whatever, but we have a very limited period of time where we've been given the gift of an opportunity. Invest in our demise via the technology or invest in the new infrastructure layer with crypto. And I think as humans are replaced out of the workforce, they'll become more speculative in nature and more community driven. We've seen this testing with meme coins. We've seen it testing with NFTs. We've seen it. There's a whole bunch of ways. We are basically speed testing a future for humanity, which is based around community, maybe speculation. I mean, we've seen the rise of predictive markets. We've seen the rise of sports betting. These things have come huge, but the more free time humans have and less ability to control their income, the more likely they're going to do that, even if universal basic equity arrives. So that's why it is a very important and very real thing is we don't have any time.
That's an interesting answer. The thing is that there's a current question going around that there will be no jobs anymore. There's no labor market anymore, especially since robots are going to take over a lot. AI is taking over a lot now too. But that's something that we thought, I think, like 20 years ago with internet, 60 years ago, 100 years ago. And every cycle, new jobs are being created and new continuation happens on all those aspects. Why is it different this time?
It isn't. This is by far the most powerful technology the world has ever seen.
I agree.
By a long way. More so than I think the splitting of the atom. I mean, this is unbelievable what is happening. So it's going to change the nature of work. But we're humans, we still need a purpose. We still enjoy, we're social creatures. We are apes. We're social creatures. We like to be around other people. We like a commonality of mind. We like a commonality of purpose. What is incredible is Web3 enables us to coalesce around these ideas and also to make money from them. So let's say you're a Manchester United fan.
Rough times, my man.
Sorry?
Rough times currently.
Yeah. But if you are passionate about that society, you could participate in their token system and work for the growth of the club, the economic growth of the club, and you participate in it. Okay, so now you've switched a hobby to now earning money. Let's say you're a Taylor Swift fan, same thing. Taylor Swift's economy is so big that she made $1 billion from touring because she doesn't make any money from streaming sales. But she moved the US economy, the UK economy, the Singapore economy, and the US economy So much so that all the central banks talked about the Taylor Swift effect. So what is our economy worth? 100 billion? 200 billion? Maybe more. So if that was tokenized and you could participate, imagine if you got her early when you first discovered her and you own the tokens. Isn't that not the same as owning Doge when it first launched? Right? These are all we are testing this. So we will find that it could be around charitable purpose. It could be, and it will be multiple communities. So we're already testing this in meme coins. You can be a member of one community, another community. You can speculate in a third community. You're active in another one. We saw that in NFTs, all the same thing. And the other thing humans will do is gravitate to be around other humans. So life experiences, nature, stuff like that becomes more valuable to us because we're living so much of our life online. So, we have an easy conversation because we met in person. So therefore we kind of know each other, we've hung around, and that human bond is actually stronger than the bond of Zoom calls. Mm-hmm. And so I think humans will gravitate towards that. So basically what I'm saying is humans are adaptive. So then when you ask a friend who's got young kids that are, let's say, 8, 9 years old, 10 years old, because they're going to come into a world which is entirely different, where a degree university means nothing. And you ask the kids, what do they want to be? And they want to be influencers. And we roll our eyes and go, this is ridiculous. Yet, in this future society, if you can create a community around you, you can create value. And so maybe they're self-adapting because they're seeing it online already. It's the 25-year-old who's pretty fucked. The 20-year-old coming out of university. Okay, because they really don't know, and the force of this is going to hit them when they're trying to get into jobs. So they're going to either have to adapt like the young kids are, or they're going to have to invest everything they can into this. The 30-something-year-olds, they've kind of established themselves. They're doing 3 jobs. They're doing what they can. They'll invest in this space. They've been big investors in this space. So it's going to be fascinating, but society will adapt, but it will also create enormous societal pressures. That I think the next election, the biggest issue is going to be AI.
Well, I mean, you touched upon a super important topic, which is, I think everything that we do has value. People might even could be confused in 6 months whether we are having an actual conversation between Raoul and me or whether it's an AI agent, but watching us might be having some value that you can earn indeed, which is also we've seen some tests with walk to earn, watch to earn, all those concepts that are community and social fi driven. And if you, on top of that, lie the 20-year-olds that are like, should I go to class or should I just learn like a specific skill and just do it online and make way more money with it, independent of which segment they take? I think there lies a lot of like future perspectives where we're going to go to, and probably also a lot of new jobs, I would say, jobs that are being created where you're actually getting paid for the time that you spend for something in actual value, because that's also an issue currently that with the ongoing inflation, it's just you're devaluing your time in your life. So I think a lot of like 15 to 20-year-olds, and I am slightly older than 25, but I see them coming out of school, knowing all these things, knowing social media, and I'm like, okay, so in the future, brands and communities are going to be so big, and I guess yours has been growing exponentially over the last few years, that is going to be the future.
But there's another side of this. We are still going to compete for attention, which is the whole game, with AI, who are very good at it.
Yep.
So people don't realize this, and I've talked about this a lot. People need to go and check out Character AI. It's like, for all of us, it's like TikTok. It's like, what? So Character AI are like anime characters and other characters that are AI chats, that the specific characters, like the good-looking bully at school, that character, whatever it's called, has 450 million conversations already. And there's thousands of these things. Many of them have over 250 million conversations already. And this is kids under the age of 16 that are becoming friends with AI. Now, we're going to say that's a fucked up world, but everything's a fucked up world. The telephone was a fucked up world. The car was everything, right? The radio, the TV, everything. This is where it's going. It's like TikTok. We are like, this is madness. There is the signal of the future, and it's happening at scale. And when none of us are seeing it, we're all talking about how cool it is to have agents on Twitter that aren't really very effective agents. Meanwhile, millions of kids are already having AI friends.
Yeah, and I think in crypto we've seen some tests with AI already. I don't know the name anymore, but there was some sort of Twitter account that actually created a trading bot that did make some money. And then we have Goat, as far as I know.
Which is terminal truths. I'm in fact interviewing Andy this afternoon about AI, and another guy called Ryan who works with him, who built another one, which is a charitable based one called Forest. Just again, this is experimentation early phase, which is what do agents do if given money, and how can AI spread memes faster than humans, which goes back to the idea is we're going to be competing for attention with AI. So it's not straightforward. Therefore, the more straightforward thing is become a tour guide of the jungles of South America. You will not be replaced.
Well, so now we know what you're going to do in like 6 years from now.
Well, that's why I've got a house in Little Cayman. It's an island of 150 people, and it's the last place the robots are coming for.
Well, yeah, I've actually been having discussions with my girlfriend of like, what are we going to do in a few years from now? And maybe just go to a small island and enjoy life. But when we're talking about that, and when we talk about the coming few years with crypto, a lot of those questions are coming to me like, how can I build something as in a portfolio? I know that you've been talking about is to not have a completely diversified portfolio because everything is just correlated as it is. Like if someone is completely relatively new or has experienced the previous cycle, has PTSD, how can you like get yourself going with the portfolio?
You have to accept the risk. There's no other way of getting the returns. Now, even if you were to mirror it and put crypto and NASDAQ, they still go up and down in the same cycle because everything is correlated to the business cycle and the liquidity cycle. So you kind of have to accept, can I deal with the massive drawdowns to have the massive upside? And if not, you just ratchet down the risk curve, which is then you go to tech stocks. And if that doesn't work, then you get to like the S&P 500. The issue is it doesn't really outperform debasement. So your salary, which doesn't go up as fast as debasement, investing in the S&P doesn't get you ahead of the game. So you only have two choices. And it's the realization that you are going to have to take risk. So then how do you take risk effectively? Firstly, have a portfolio that is sensible, which is I own the largest tokens. You know, if you're going to do
Bitcoin,
one thing, own
ETH.
Bitcoin. If you're going to own two, own Bitcoin and ETH. If you're going to own three, own Bitcoin, ETH and Solana maybe. Whatever, right? Do that. Also, maintain an income. Then, when your portfolio goes down, you're okay. And then think about this idea that I have about taking lifestyle chips off. Because if it really matters to you that now your portfolio's up and you're terrified of losing that money because it can enable this in your life, then do that thing in your life. If it doesn't really matter because you're living in a house or you're doing whatever you need or you're really young and it's like, it doesn't matter to me yet, fuck it, just go for it. And then use your income when you can to buy the sell-offs. So it really does depend. There's no easy way around it. It depends on your risk tolerance and your understanding of how rewards are generated.
I think I agree on that sense. And I think that having a large portion in your blue chips, which is often being said about Bitcoin and ETH and Solana, makes a lot of sense too. The question I often get though, and probably you will get this as well, is what about ETH? What's happening there?
So
should it still be there, or should it be changed for, let's say, Solana?
So my view on ETH is they have overbuilt for the current requirements, for the current demand for block space, or for their block space, because this was the layer 2 scaling. However, if you're anybody in the financial industry, if you're going to build anything at scale, you will probably only do it on ETH, because you won't get fired, because it's safe,
Compliant.
it's distributed, it is interoperable with so many different areas. It's proven. So if I think where the financial industry will go, which is a quadrillion-dollar industry or more, it's going to go there. Bitcoin, yes, as a collateral, for sure, and as an investment vehicle. But in terms of building on top of, I think that narrative will catch hold and ETH will catch up. And I think the next cycle, we'll see ETH scale, much like we all see Bitcoin scale. You know, will something flip each other in that thing? Maybe. Who the hell knows? You don't need to make that bet. So I don't worry about ETH at all. But again, our job is to make as much money as we can in this cycle if, you know, we've been around and you understand how to allocate assets. So in which case, I don't hold much ETH. The only ETH I hold is the long-term NFT collection that I've been building. And I've been mainly long Solana.
Well, I think we're a little the opposite of each other there. I'm heavily exposed to ETH at this stage. I'm heavily exposed into... one of the things is I missed Solana, so I'm kind of fed up by some emotions of missing the run, which is a bad thing to have when it comes to investing. The second thing is that I think that at this stage, DeFi is so undervalued that there's such a big market still about to enter. And where are they going to go to? Most likely, most of them are going to ETH. Then after that, you probably have Sui. There's some DeFi starting to fire up there. I just don't see that much on Solana yet, except for all the trading on DEXs taking place in meme coins. I just believe that DeFi is going to be the next big trigger when it comes to the market. So, I mean, in your opinion, what type of narratives are going to push this market forward from here?
I think the narrative is going to be Bitcoin flows and then people going out the risk curve as people build. Look, we still haven't built gaming at scale.
Well, off the grid.
Off the grid. Avalanche built, well, backed that. But I think, you know, Sui's sweet spot is that as well. Yeah, because it's super fast and super effective at certain things. We haven't seen the wholesale conversion of Web 2. We haven't seen payment system integration outside of stable coins. And I'm talking here about maybe Doge on X or whatever it may be, right? We saw a bunch of these guys experiment, like Reddit last cycle, but didn't because of regulation. But the regulation changes. So I think the lack of regulatory headwind will create opportunity for a lot of the people who haven't been in to come in. And that'll be enough. I don't think you're wrong about DeFi. I do think DeFi is not easy to use for non-crypto natives still. So it needs to be embedded in a simpler way. What that means, I don't know. Does regulation mean that the ETH ETFs give yield? Okay, that's a big game.
Yeah.
So I don't disagree. I think ETH will do very well. I've no issues with it. Yeah, I have no issue. I've seen your point of view that as rates get lower, more people get pushed to DeFi. I think that's probably pretty true as well. I think that's pretty interesting. I do worry about the restaking yields.
Really? Why?
Well, I've been in finance long enough.
Or?
There's no such thing as a 20% yield without commensurate risk. I mean, it's just every fucking time. And so that nobody knows where the risk is. Everyone goes, well, it's smart contract, it's all fine. But what's the other side of the risk equation? Who's doing the borrowing? Where's the leverage coming from? Where's it ending up with? And who blows up? It's just a matter of who blows up. So that's why I don't like it. I understand if you're very crypto native, you understand the risks you're taking, you do it for periods of time when you think it's relatively safe. But it's not like, oh, I can ride out the bear market in restaking yields. My guess is, half of this stuff all goes negative.
I've been going through it with the DeFi yield back in the day. But the thing is that you've got a lot of revenue generating protocols at this point. For instance, if you go to Hyperliquid as a DEX, I think it's a good interface. It's pretty easy to use. The only concern you need to have is that you need to have a decentralized wallet to actually execute those orders. And that's where the trick comes in. MetaMask is not going to attract billions of users. It's super hard to handle. But if you have an integrated wallet that is super easy on your telephone to use or on your mobile phone to use, then on top of that, having all the regulatory frameworks that is pushing back a lot of those projects to not launch on a SEX and launch on a DEX, it's going to increase the DeFi market. Where, for instance, Hyperliquid, coming back to that point, you can also get a revenue by staking the actual token, which is, I think, the last time I checked, the APR is 20% or so. But that is backed by revenue. And a lot of the restaking protocols or early stage projects that are saying that they have a high return or high yield is actually just to attract stakers to grow the ecosystem. But in my opinion, you shouldn't be needing those stakers to grow the ecosystem. The ecosystem should grow by itself, by the product that is being built. But we kind of need restaking. Or is your thesis on restaking different?
Revenue goes up, revenue goes down.
Mm-hmm.
And once the restaking yield disappears, we don't know who's caught the other side of some of this stuff. What I do know, however, is that if you look at the leverage being created by MicroStrategies, it's actually ending up in traditional hedge funds who are more practiced at risk taking. And so maybe it's more manageable. We don't know. Somebody will probably get over their ski tips and blow up. But I think the nature of liquidity providers will change over time. So I think we will see the large lending pools of the banks and the asset management firms, the Apollos, these kind of people enter the lending markets, and that will make it far more robust. It'll bring yields down, obviously, but I think it has a chance to be far more robust because of regulation. The other mismatch we've still got in crypto is the VC market versus the hedge fund market. So the hedge fund market is way too small versus the overall size of the market and the overall size of VC. So traditional hedge funds are $4 trillion in assets. Crypto hedge funds, even with the recent rally, maybe 10 billion max. So 10 billion is the entire professional capital in the market that's trading, providing liquidity outside of the trading shops, of which there's 5 or 6 of those unregulated market-making shops. But the hedge funds are too small. So what's happening is VC is getting tokens, they're coming onto the market, and they're falling 80%. Almost every new coin does. Why? It's because the secondary market's not liquid enough. And there's too much liquidity in the primary markets. Mm-hmm. That actually creates a supernormal profit for hedge funds because they can buy great tokens very cheaply after they come out. But over time, that will arbitrage and we'll find an equilibrium that is more similar to IPO markets. But right now, it's dysfunctional. Like DeFi is dysfunctional because the leverage is not in super professional hands, which is what we learned last time around with 3 Arrows Capital.
I recently have jumped myself into the venture capital game, which I had the ethical idea that going from being an influencer KOL, where there are a lot of bad actors, is that once you step up and become a VC, it's a good world where everybody just cheers for each other, etc., etc. However, there are a lot of unknowingly unexperienced VC guys out there just investing into protocols as valuations that I'm like, I wouldn't be doing that. I'm not going to name some, but a lot of VCs were spending money into protocols at billions of valuations just to gather management fees from their clients by keeping on investing into crypto. And I think we're currently seeing that there are just a few hedge fund traders. I mean, the OTC markets are barely opening up, and there are so massive discounts taking place at this point. I mean, some coins can be bought for like 40 to 50% discount at this stage because there's just no one buying them. But on the other hand, the venture capitals are just overexposed. And I think in terms of group of companies that are going to be hurt in the next cycle, it's gonna be the venture capitals. Can't be different.
And they got hurt last time around as well. But they had the one trick up their sleeve is most of them don't even care about equity anymore.
Mm-hmm.
They get decent returns from the token side, but we've got this issue of this mismatch. So
Yeah.
it's very interesting. I set up a Exponential Age Asset Management, which is a fund of crypto hedge funds, because I think there's more opportunity in the secondary markets than there are in VC markets because of the excess capital in VC, meaning it's driving up valuations, which drives down future potential returns, while liquid markets, there is still a disconnect. We'll see how it plays out, but it's very interesting.
From my perspective, actually, if you're a retail investor at this point, or actually in my case, if we are an investor, liquid assets are providing such a big opportunity in terms of risk and return that you could have, because you can buy a certain asset that is yet to go up and you can liquidate at all costs and all times if you want. While if you're a venture capital and you invest into something, you don't know at which valuation it goes live. You don't know whether the exchange screws you over. You don't know whether it's going to be postponed because the timing is off. So I think the liquid markets and also the secondary markets are a good market where it goes through. And one of the concerns that we have, which is one of the final questions that I wanted to ask you, is if someone is listening to us today, to you, and says, okay, the next few years are going to be super important. All those altcoins and crypto is going to go through the banana zone. They go up vertically. How are you going to handle those emotions, and how are you considering taking profits? Like, I know the feelings from the previous cycles and the amount of cheer that you had, but actually during those moments you should have been rational.
There is a trick, and it was taught to me when I was running a hedge fund. The trick is every trade you do, you give an entry, a stop loss if you use them, or an idea stop loss when your idea is wrong, because it's difficult to use stop loss in crypto unless you're really short-term time horizons. But an idea stop loss is it's not scaling, we're not seeing adoption, they're not meeting their roadmap, whatever it may be.
A fundamental stop loss, basically.
Yes, but what you do is you write down your thesis. You then write where you're going to take profits. So on the Real Vision platform, we have this in our trade ideas to force people to do this. I was forced to do this when I was starting to run a hedge fund. The guy said, look, here's the trick of managing your emotions, is take the emotions out. Your emotion is finding a great idea. That's your emotion. The rest, it needs to play out. And it will play out one way or the other. You'll either win or you won't. And if you do that one trick of writing it down and holding yourself accountable, you won't get that ridiculous FOMO with it could go up another 10x. It's like, I was happy to take profits here, so I should take profits here.
And yeah, I know, but probably there will be coins that are going to be going through mass cycle adoption, or for instance, a coin goes 200x and I did a 10 on 15x on it. Like, there's always the temptation to get back into it.
I know. And
I still have it.
We all do, my friend. It's really hard. It's really hard. And in the end, you've got to realize that if you get back in at a higher price, you're assuming more risk. So when I sold Bitcoin, I'd bought it at 200, sold it at 2000, a 10x. Fantastic. In my world at that time, that was like a heroic trade. And it went up another 10x. I did not buy back in. And I was comfortable because I'd made 10x. And I told myself it's okay. Because if I had then realized, oh, fuck, I should get back in, I buy back in, it's 10,000. It was only like 3 weeks that it went from 10,000 to 20,000 and then back down. Your risk increases so much further than an entry price at 200.
Mm-hmm.
So you just have to realize you just have to become a little bit more stoic.
Yeah.
And say, I'm happy to accept what I've got and not what could have been. Because there's always somebody on X that's making more money than you. There's always somebody who's talking about the trade that did 100x that you never got. There's always somebody laughing, saying, look how much money I'm making in meme coins. You don't know the truth.
Mm-hmm.
You don't know how many zeros they've had. You don't actually know their P&L. You don't even know if they've got $100 or $100 million. You don't know anything. So you've just got to step back and say, what matters for me? Am I trying to compete with random people that I actually don't know the truth about? Or am I trying to unfuck my future? And if we're trying to unfuck your future, it'll try and stop you taking too much risk at the wrong time.
Maybe you need to become a little Dutch.
I'm already half Dutch. It's enough for me.
Yeah. Well, you're taller than me, though. So, I mean,
Just.
Final question, Raoul. I know you're a hard-working, content creator, but also entrepreneur, doing all sorts of stuff. What makes you happy? What is your end goal?
Well, partly it's money and security, but it's also, this is the biggest macro opportunity of all time. And so partly it's ego. I want to nail this. This is the big one. I worked my entire fucking career for this one bet. Here it is. And I'm going to take that bet in as many different ways as possible. The other thing is I understood very early from Occupy Wall Street onwards that it really mattered to people and that they needed to unfuck their futures and that it's creating societal discontent. And if I can help as many people as possible and it aligns with my own personal goals, well, that's a win-win. That's kind of like the idea of that community idea where you can participate in a community. Well, my community is people who want to unfuck their future. And you know what? It does it for me too. It does it for the system wide as well, because we need it, because the system is broken, and it helps people. So if you've got such alignment of interest, and it's the greatest macro trade of all time, got to do it.
Well, thank you very much, Raoul, for spending some time with me on this podcast. I've been following you for years and watching your videos, so I would love to see them progress over the years and see where we go through this exponential age. Thank you for being here. It was a wonderful conversation, and I hope to see you in the next year again on this channel, discussing everything that we do. Any final words that you would like to say?
I've actually got a document that's free. If you join Real Vision, which is free, realvision.com/join, there is a whole document that's there for you around how to unfuck your future and also the 6 years idea. And I think people find it very useful. So if you're watching this and you care about what you're trying to do, it's free to join Real Vision. It's been a superpower. It's changed many people's lives. So realvision.com/join.
I'll make sure that the link is in the description beneath. So if people want to go to Real Vision, then they can easily click on the link in the description. So once again, thank you very much, Raoul.
Thank you, my friend. I'll see you soon.